The debt-to-capital ratio is a financial metric that helps assess a company's financial stability by comparing its total debt to its total capital. This ratio is crucial for understanding the proportion of a company's capital structure that is financed through debt, which in turn indicates the company's financial leverage and risk. Unlike liquidity ratios that focus on a company's ability to cover short-term obligations or profitability ratios that measure overall financial performance, the debt-to-capital ratio provides insight into how much of the company's capital comes from debt versus equity. It is especially valuable in analyzing leverage and financial risk compared to other ratios like the debt-to-equity ratio or the long-term debt ratio, as it includes all forms of debt in relation to the total capital. Debt-to-capital ratio. The debt-to-capital ratio is calculated by dividing the company's total debt by its total capital. Total capital is the sum of total debt and total equity. Essentially, this ratio shows the proportion of a company's capital that is derived from debt. For example, if a company has total debt of $500,000 and total equity of $1 million, its total capital would be $1,500,000. The debt-to-capital ratio would be the total debt divided by this total capital, illustrating the extent to which debt is used to finance the company's operations. Example. Let's consider a company, XYZ Corporation, which has total debt of $600,000 and total equity of $900,000. To calculate the debt-to-capital ratio. 1. First, determine the total capital by adding total debt and total equity, which in this case is $600,000 plus $900,000 equals $1,500,000. 2. Then, divide the total debt by the total capital, resulting in $600,000 divided by $1,500,000. The resulting ratio is 0.4 or 40%. This means that 40% of XYZ Corp's capital is financed through debt, while the remaining 60% is financed through equity. Low debt-to-capital ratio. A low debt-to-capital ratio suggests that a company relies more on equity than debt for its financing. This typically indicates lower financial risk, as the company is less dependent on borrowed funds and may be better positioned to withstand economic downturns or fluctuations in interest rates. For instance, a company with a ratio of 20% implies that only 20% of its capital structure consists of debt, reflecting a conservative approach to borrowing and potentially greater financial stability. High debt-to-capital ratio. Conversely, a high debt-to-capital ratio indicates that a significant portion of the company's capital is derived from debt. This can suggest higher financial risk, as the company is more leveraged and may face challenges with debt repayments, especially in adverse economic conditions. For example, a ratio of 70% means that 70% of the company's capital is financed through debt, which could signal aggressive borrowing strategies or higher risk levels. How can companies optimize debt-to-capital ratio? Reduce debt levels. Companies can lower their debt-to-capital ratio by paying down existing debt. This reduction in debt decreases the numerator of the ratio, thereby improving the ratio. Increase equity. Raising additional equity through issuing new shares or reinvesting profits can help increase total equity. This increase in the denominator of the ratio will improve the debt-to-capital ratio. Improve earnings and profitability. Enhancing overall profitability can lead to higher retained earnings, which in turn increases equity. As equity grows, the ratio of debt to capital improves, reflecting better financial stability. Key takeaways. The debt-to-capital ratio is a key indicator of financial leverage and risk, providing insight into how a company's capital structure is funded. It compares total debt to total capital, showing the proportion of a company's capital that is financed through debt. A low ratio indicates lower financial risk, suggesting a greater reliance on equity and a more conservative financial approach. A high ratio signifies higher financial risk, reflecting increased leverage and potential vulnerability to financial challenges. Understanding and managing this ratio is crucial for maintaining financial health and ensuring balanced capital structure.